Welcome, my dear followers, in this video. Is it the best time to buy Onyxcoin? We will analyze it. Don't forget to subscribe and like, and please watch to the end to understand. When we take a broader look at the weekly time frame, a highly notable candlestick formation emerges on the chart, the bullish engulfing pattern. In technical analysis, this formation is considered one of the strongest signals of a potential trend reversal, especially when it appears after a prolonged downtrend. It often indicates a significant shift in momentum and suggests that the market may be preparing for a directional change. Looking closely at the structure of this formation, we can see that the current week has printed a large green bullish candle that completely engulfs the red bearish candle from the previous week. From a technical standpoint, this signals that sellers are starting to lose control, while buyers are stepping in with strong conviction. During downtrends, the market often moves in a state of fear or panic, but the appearance of a bullish engulfing candle suggests that investor confidence is beginning to return. Therefore, this pattern carries strong implications not only from a technical standpoint, but also in terms of market psychology. The fact that this pattern has appeared on a weekly chart significantly increases its reliability and potential impact. Similar formations on daily or intraday charts are more common and often result in short-term reactions. However, when such a formation shows up on a higher time frame like the weekly chart, it tends to signal more sustainable and long-term trend changes. As a result, this bullish engulfing pattern could mark a potential bottom, offering a valuable reference point for long-term investors. Additionally, when we observe the area in which this formation has appeared, it's clear that price has interacted with this level multiple times in the past, often rebounding from it. This suggests that the current level is functioning as a psychological support zone. In previous instances, investors saw this level as a buying opportunity, and the current reaction reinforces its importance as a strong support. From a behavioral finance perspective, such reversal patterns act as a ray of hope for investors. Prolonged downtrends typically generate discouragement and impatience, but when a powerful bullish candle appears, it shifts sentiment, reignites buying interest, and typically leads to volume-supported price increases. And when rising prices are backed by strong volume, the resulting moves tend to be more sustainable, often laying the groundwork for a new trend. Bullish engulfing patterns are also widely recognized in technical analysis as reversal signals. The price action that follows these setups doesn't usually end with just a few weeks of upward movement. It can often lead to months-long rallies, particularly when supported by favorable macroeconomic conditions or sector-specific catalysts. At this stage, the most important thing investors can do is to wait patiently for confirmation. If, over the coming weeks, the price continues to hold above this level, or better yet, begins to form a new leg up, it would serve as strong validation for the bullish engulfing pattern. From there, when combined with other technical tools, like support resistance levels, moving averages, or indicators like MACD and RSI, investors can build a confluence of signals, helping to reinforce confidence in the trade setup. In conclusion, the bullish engulfing formation that has developed on the weekly chart currently stands out as a very strong and promising signal. Both technically and psychologically, it suggests that the price may have formed a bottom and is potentially preparing for a new upward movement. For long-term investors, this zone could represent a value area with high potential. Of course, nothing in the markets is ever guaranteed, and every technical pattern carries the possibility of failure. But based on the current data, this level offers a solid foundation for potential medium to long-term gains. That said, it's crucial to remember, candlestick formations alone are not enough. We must also consider other metrics to avoid making incomplete or misleading analyses. Stay tuned. When we closely examine the chart, we can clearly observe the formation of a classic and widely recognized technical pattern, the cup and handle. This structure is often used in technical analysis as a reliable tool to forecast potential future price direction based on historical price behavior. It typically appears after a market has experienced a downturn, followed by a period of recovery and a short consolidation phase where the market gathers strength. In the current chart setup, this exact scenario is playing out. The price has approached key resistance levels once again, forming a textbook cup pattern along the way. Let's break this down, starting with the cup portion. We see that the price dropped sharply from a certain level, then slowly found a bottom and began to gradually climb back to where the drop initially started. This phase often reflects the market's psychological recovery, where selling pressure eases, investor confidence begins to rebuild, and buyers progressively re-enter the market. The smoother and more symmetrical the cup formation, the healthier the market recovery tends to be. In our current setup, the cup is well-formed, balanced, and rounded, offering strong bullish implications. Next comes the handle, which forms after the cup is completed. This part typically represents a short-term pullback or consolidation, often taking shape as a small descending channel or tight triangle. It's a phase where the market catches its breath, early profit-taking occurs, and new buyers begin to position themselves. During this handle phase, trading volume generally declines, reflecting a temporary pause. However, the key thing to watch here is the breakout. If the price breaks out of the handle to the upside with increased volume, it officially activates the cup and handle formation. Breakouts following the handle are often sharp and decisive. By this stage, price has compressed, traders have been on standby, and once direction is confirmed, they commit. The target after a breakout is typically measured from the bottom of the cup to its top, a distance known as the cup depth. In our current situation, if the price successfully breaks out above the handle, there's a clear upside potential equal to the depth of the cup, which represents a highly credible target according to historical backtesting and technical theory. That said, certain conditions must be met for the pattern to remain valid and technically sound. For example, if the breakout lacks volume, it could be a false breakout. Also, if the handle drags on for too long or external news disrupts price action, the structure could weaken. So far, the handle appears well balanced, and the overall formation remains intact, which is a positive sign. Moreover, cup and handle patterns tend to be much more reliable on higher timeframes, such as the weekly chart. When such a formation appears on a broader scale, it suggests the participation of larger market players, including institutional investors. If this pattern is unfolding on a weekly chart, as is the case here, it may present a clear long-term opportunity for position traders or investors. Taking all these factors into account, the developing cup and handle pattern on the chart is generating a signal that deserves close attention. From its clean structure to the current volume and price behavior, it indicates that a strong upward move could follow once the handle resolves to the upside. For investors who base their decisions on technical analysis, the evolution and breakout direction of this formation will be critically important. It's also worth noting that this pattern may take several more weeks to fully develop, given that it is forming on the weekly time frame. When we carefully observe the chart, we witness the formation of a highly notable pattern through one of the technical analysis tools, the vortex indicator, which provides significant insight into understanding price direction. The vortex is a technical indicator that helps us understand the direction and strength of a trend and is particularly effective in generating signals for medium and long-term movements. This indicator consists of two separate lines, the blue line, which shows positive directional movement, and the red line, which represents negative directional movement. The intersections and positions of these two lines offer important clues for analyzing in which direction the price is moving more dominantly. When we evaluate the current situation, we observe that the blue line of the vortex indicator has been above the red line for quite some time. This outlook is considered highly positive in technical analysis. The blue line being positioned above the red one indicates that buying pressure in the market is outweighing selling pressure and that buyers are taking control. Furthermore, the fact that this gap has been maintained for a long time suggests that the trend is based on a solid foundation and that the rise is not just a short-term reaction, but rather part of a broader movement. The continued dominance of the blue line confirms that prices are moving in an uptrend by forming consecutively higher highs and higher lows. Especially in trend-following indicators like the vortex, continuity is very important. Since momentary intersections can sometimes be misleading, the fact that the blue line has maintained superiority for this long is a very positive signal for investors to confidently hold on to their long positions. It's also worth noting that this type of strong appearance in the vortex indicator usually doesn't reverse suddenly, but rather changes through gradually forming signs of weakening. Therefore, as long as the blue line continues to remain strongly above, the trend is considered to be continuing. At the same time, this supports the principle of the trend is your friend, encouraging investors to stick to their positions. However, it should be noted that if the blue line starts to approach the red one or an intersection occurs, this could be the first signal of a trend reversal. The fact that such a formation has not yet occurred shows us that the upward trend is still valid. Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.